If you spend any morning in March checking your portfolio before your coffee was ready, wondering if you should sell, wondering if your advisor was right, wondering if everything you built over 30 years was about to unravel, I need you to hear something. That feeling wasn't irrational, and it wasn't weakness. Your plan was sending you a signal. Every advisor in America said the same thing in March. Stay the course, you're diversified, markets recover. They were right about markets. The S&P hit new highs in May. But they were wrong about something more important, the way your plan actually breaks under pressure. And that's what we need to talk about today. First, if you built significant wealth over decades that took discipline that most people never achieve, I want you to know that I understand why March, because you're smart enough to sense that something in your plan didn't hold up the way it was supposed to. I've been where you are, not as an observer. I was on Wall Street in 2000. I watched people who did everything right, saved, diversified, followed the plan, and they lost half their wealth. Not because markets didn't recover, they did, but those people needed income before their recovery actually arrived. That experience taught me something that I've carried for almost 20 years. The crash isn't the real problem. It's what happens when everything meant to protect you fails at the same time. That's what happened in 2008. And it's exactly what happened again in March. Now, you already know about sequence risk. You know you shouldn't panic sell. You've heard of the bucket strategy. Cash here, bonds there, stocks for growth. I'm not going to relitigate any of that. You've done the reading. What I want to show you is the thing underneath all of that advice that nobody's questioning. Every retirement plan is built on a hidden assumption that your backup systems fail one at a time. Stocks drop, bonds cushion you. Bonds struggle, your cash covers the gap. The economy weakens, the Fed cuts rates and helps the recovery along. Each layer catches you when the other one slips. For long stretches, that assumption held well enough that most plans were built around it. Now, in March, it broke. We're talking about 3 failures the same quarter. The Iran war disrupted traffic through the Strait of Hormuz. Oil surged 55%. Brent hit $120 a barrel. Stocks dropped. The S&P fell about 9% peak to trough. Tech was hit harder, down over 18% from its highs. And that was expected. Here's what that actually means in plain English. Bonds were under pressure at the same time. Oil prices pushed inflation expectations up. Rates rose. Bond prices fell alongside those stocks. The thing your diversified portfolio depends on, stocks and bonds moving in opposite directions. Now that vanished. And your cash? Gas hit over $4 per gallon. Groceries jumped. CPI hit 3%. Your safe money was steadily losing purchasing power. And the Fed? The backstop that rescued us in 2008, that rescued us in 2020, it couldn't cut rates because inflation was running too high. The institutional rescue wasn't coming in this time. Now, I had a conversation in March that I haven't stopped thinking about. A couple in their early 60s, retired about 8 weeks now, did everything they were told, diversified, had some cash set aside. The advisor gave them the green light. The wife looked at me across the table and said, "Are we going to be okay?" And the honest answer, given how their plan was structured, was that I wasn't sure yet. Because their plan had never been tested against what was actually happening, not a market crash, not an inflation spike, not a rate freeze, but all 3. And in the same quarter, their backup systems weren't independent. They were connected through inflation. And when a supply shock hit, it degraded every single one of them at the same time. And here's what's wrong about this. And I mean genuinely wrong. These are people who followed every piece of advice that they were given. And they saved for decades. They worked with professionals. And they built a diversified portfolio everyone told them to build. They did everything right. And they're sitting across from me scared because the plan that was supposed to protect them was never stress tested against a real world scenario. Now that shouldn't happen. And it doesn't have to. Okay. So here's what I want you to actually do with this. Go find your most recent retirement projection, the one your advisor showed. And I want you to ask 3 questions, not one at a time, all 3 at once. I call this the simultaneous stress test. Question 1, what happens to your portfolio if stocks drop 15% and bonds drop 5% in the same quarter? That's roughly what March looked like. If you're sitting at 2 million, you're now at about 1.7. Question 2, at that new number, what's your actual withdrawal rate? You plan for 80,000 a year. That was 4% on 2 million. On 1.7, the same 80,000 is now 4.7%. Above Morningstar's safe rate for 2026. Question 3, while all of this has happened, did your cost of living also go up? Gas was up $1 a gallon at least. Groceries up 5 to 8%. If your annual expenses jump from 80 to 86,000, you're now withdrawing at 5.1% of your reduced portfolio. Now that's the difference between a stable plan and one that starts to slip. 3 questions, 1 penny, 10 minutes. And you'll know whether your plan has ever been tested against what just happened in real life. If it hasn't, and most standard projections don't clearly show what happens when multiple risks hit at once, then your plan has a blind spot. And now you can see it. The simultaneous stress test tells you whether you have a gap. Closing it, that's what crisis capital engineering is really built for. And I want to be clear about what this is. Crisis capital isn't a savings account sitting next to your portfolio. It's really a tiered liquidity architecture, 3 layers designed to function when every backup is compromised at once. In plain terms, it's money positioned in different places, so you always know exactly where your next 1, 2, and 3 years of income are coming. Immediate access for the first 6 to 12 months. Short-term reserves bridging you through these next 24 months. And an intermediate layer that buys your long-term investments the time to recover without you having to touch that. Each tier draws from different accounts at different tax rates with triggers that refill automatically during recovery. It's engineered for your specific income needs, your specific accounts, and your specific tax situation. That couple that I mentioned before, the wife who asked, are we going to be okay? If they had this architecture in place before they retired, that conversation, that never happens. Sure, he knows the answer. Here's what it comes down to. The people who slept through March didn't have better nerves, they had better architecture. Stay the course is great advice. If your plan actually lets you follow it, run the simultaneous stress test. If your plan passes, you'll sleep better knowing it's been tested against reality. If it doesn't, now you know exactly where the gap is. If you have more questions about this, or you need help walking through it for your personal situation, go to jonathanpeters.net for a consultation and schedule your retirement resilience assessment. The next simultaneous failure is coming. You know it is. Not because I'm pessimistic, but because we've seen it happen at least 4 times in the last 18 years. The difference between the people who recover and the people who don't isn't luck. It's what they built before it hit.